Hey, good morning. Let's go over today's trade plan. So the overnight session has been pretty balanced where ES probed higher and tested the 71.5 gap, found resistance there, and right now is very two-sided. Now we know that overnight the buy side has been more dominant and Friday closed on strength, but this is a important inflection point and the market is testing larger time frame resistance, and the question right now heading into the open is whether the strength that we saw on Friday is going to be followed up with continuation higher, and whether the breakout above the 65 to 67 area is really going to hold. So off the open, we do need to see continued broad market strength and upside momentum in order for the buyers to maintain control. And because we're at a important inflection point, our short-term bias is going to be relatively neutral. We have to be open to a possible move to the upside, which is continuation, or a failure at the breakout area and a move to the downside. So we're going to use 61 to 63 as not only the pre-market support zone, but also as the short-term micro bull bear zone. So if the market is holding above 61.63, above the 64.75 prior VPOC, then we know that the buy side still has a shot at maintaining control and going higher and retesting the 70 half to 72 half and above that at 78 to 80 half. But if the market breaks below 61 to 63, then that could open the door to a possible failed breakout attempt, in which case we can see some short-term liquidation down into the 49 to 51. The 57 to 58 support zone that's marked up here, that one is really only going to be used if we're noticing that it's a false breakdown attempt. So if the market, for example, tries to break 61, but the underlying internals are still signaling strength, or if there's not really a whole lot of downside momentum to the move, where the tick is still spending more time above zero as the market goes into 57, 58, then in that particular situation, it can make sense to fade the 57, 58 area. But if the market's breaking down below 61, 63 on heavy momentum and the price action is bearish, and now the intraday bias is more bearish, then we could see a move down into 49 to 51 before we get any decent enough buy response. And at 49 to 51, we can anticipate a reaction. It's an important area. It's the breakout area from Friday, and that zone has high odds of at least providing some level of response and reaction. But the bigger question that we're going to be answering on the day time frame is really whether this breakout is going to stick, whether it's a legitimate breakout that can really go higher, or are we simply not seeing enough strength in the market to really follow it up with another swing high and a move up to 78 to 80 half. So the upside objective in the event that we are seeing upside momentum and broad market strength is going to be 78 to 80 half. But just understand that we are at some decent resistance and the market can really move in either direction. Don't be so locked in to just purely a bullish view. At least we have to be open-minded and open to the idea that there's a possibility of a failure to break out. We're going to give the edge to the buy side until we start seeing some signs that the sell side is really stepping in, but we just have to be open to it and not get blindsided. At the same time, simply a lack of strength up here can really be enough of a reason for the sellers to step in. So at the 70 half to 72 half pre-market resistance or 69.75 HVN, if the market's trading there and there's really just no upside momentum, if the tick is really mediocre or more negative, then that can be enough of a reason for sellers to step in. Now beyond that, on the upside, 78 to 80 half is valid resistance on first test. It's a spot where responsive sellers can be active, and 86 to 88 is larger time frame resistance. It's also a range extreme, so that's an area that can cap the upside. But even 78 to 80.5 is a spot where the sell side can be active on first test, and then we can just continue to balance a bit. Same idea applies to 86, 88. As we go higher, we are starting to test even more larger time frame resistance, and that's exactly why our bias on the short term is more neutral today, right? Because the risk reward at, for example, that 33 half to 35 half zone from Friday is much, much better for the buyers as opposed to, buying 69 or 70, right? The reward to risk is not as high. And, for that reason, we have to back off the bullish bias and approach the market with a more neutral bias where we're open to a downside move, and at the same time we're aware of the fact that we still have to get somewhat decent trade location in order to really be able to hold a long setup from these aggressive prices and then have the patience to see it through. If we're in from a very aggressive spot, then those are going to be the weak hands. The weak hands are the ones that are buying it too high, and now they don't really have enough room in the trade to really allow it to work. So we need to be mindful of that too. So it's an interesting context here. We'll just have to keep an eye on the broader market. Approaching it with a fairly neutral bias, and we'll just have to see what kind of momentum we get off the open and what type of price action we get. But we're open to a move in either direction today, and giving edge to buyers above 64.75, 61.63. But if that area doesn't hold, then we have to be willing to adjust our bias. Or if the market tests resistance and there's just no real strength behind it and no momentum behind it, then that could again, switch our bias to more of a bearish bias and bring sellers into the picture. So those are the main thoughts heading into the open. Let's see how the market reacts at the previous VPOC and whether it can hold the pre-market support here, and we'll take it from there.